Ho, ho, ho. Merry Christmas. It's wonderful to see you all here today, although I can't see you and you can't see us. Gulnara and I are sitting here wanting to have a little bit of a chat because it's Christmas morning and we have nothing better to do and our family is in other countries. We realised that last year we made some burning forecasts which left us burnt because they weren't particularly good, and there'll be a blog post up about that in the next week or so. Today we're going to focus instead on what our forecasts for 2024 are, or at least starting to think about those. And we want to chat about that because we think, when you go out and you go to Christmas dinner, you need something to argue with your family about. And we want to be here for you to help prepare you for those conversations and get you ready to have a debate. So in order to think about the scenarios it would be great to bring up over a Christmas lunch, I'd like to hand over to Gulnara. What do you think are a couple of interesting things we could chat about?
Hi Matt, hi everyone online. Today we are going to talk about the two economic scenarios. The first one is contagion from the declining Chinese housing market to domestic demand. And the second one is an unprecedented fall in broad-based commodity prices.
Interesting. So they're two quite related shocks,
Yeah.
but they're economic shocks. I don't see much to do with policy itself there.
Oh, in terms of the policy debates, we might come back to that in our future podcasts.
Or just a blog post. I don't know if we need to do more podcasts. But very good.
So let's start with the economic scenarios with the Chinese housing market stuff.
Okay. So what exactly is going on in China? How do we think about that?
So Cato article, which is called Anatomy of China's Housing Crisis Ending Financial Repression.
Okay, I'll put that in a link below.
Yeah, so Cato article gives a good summary of the circumstances leading to the current drop in house building activity and failure of major developers. But we want to focus on the housing market, the wealth of Chinese households and consequent implications for domestic demand in China.
Okay, so your focus is less on sort of financial stability itself and a lot of the things that are in the media about Chinese banks doing X, doing Y. You're more interested in the Chinese consumer.
Yeah.
Okay, so what has been happening with Chinese savers?
Yeah, I think you would be best to give us a little bit of an outline about like the history and what was happening with Chinese savings. I'll hand it over to you.
You know I can't shut my mouth, so
Sure.
let me just jump in on this. When we think about China and Chinese growth since the Asian financial crisis, which was 1997, China has become a country where households save a lot. And there's a whole lot of waffle about it being a cultural thing, but a lot of that's tacit racism. Really what's going on a lot of the time is that there has been strong policy emphasis on making sure that there's subsidies for certain types of activities. Up until the global financial crisis in 2008, that was manufactured exports. After 2008, it was the property market. So you have these households that feel compelled to save, and then due to that compulsion to save, there's a lot of household savings occurring in terms of deposits, but that isn't necessarily what Chinese households want to be saving in. They want a bit more access to money. They want something they see as more tangible and less likely to be taken away from themselves. So since the global financial crisis, they've invested a lot in housing and house prices have shot up. Now, what has happened more recently that's led to this sort of model unwinding?
So I think in this case, households realized that they could buy and sell domestic property with relatively few restrictions until 2020. And from 2020, the Chinese government imposed strong rules limiting leverage in the property sector, and the property bubbles has popped. So from a Chinese household perspective, this reduces the expected value of their savings in two ways. Firstly, by making the existing deposits more risky, and secondly, by reducing the value of their housing assets. If it is the case that households in China have experienced a massive wealth shock, then there may be a sharp reduction in their spending over the next year, a massive negative shock to aggregate demand.
So there's a couple of things I'd like to keep in mind with that. Chinese household savings data is a little bit out of date compared to other countries, but if we look pre-COVID, it was around 35% of disposable income. That compares quite favorably to a lot of other countries where it is pretty close to zero, or even a country that's got relatively normal to high levels of household savings like the United States, which feels like a weird thing to say. It was more around 9%. Now, when we look at the COVID period, and especially the post-COVID period, there's been a sharp increase in the number of deposits, especially quite long-term deposits, that have been taken up by Chinese households. Now, at face value, that's led to that vehicle driving past really loudly because it loves to do that. But then more importantly, it's led to a lot of people saying that Chinese consumers are going to come back and there's going to be a huge surge in demand. And the reason for that is because they have all these deposits. What it sounds like you're saying is that actually Chinese households won't sit there and they won't turn around and spend more because there's a reason why the saving has gone up. It's gone up because there could have been external pressure from the government. It's gone up because of concerns that they may be losing their stock of savings due to it going to risky property investment. There may be concerns about the loss in the value of their house due to house prices being at great risk. And when you put all that together, Chinese consumers are now much more risk averse than they were before. And with the lack of a proper safety net in China, with a whole lot of uncertainty about what's actually happening and the data that's available, Chinese consumers might be in a really bad situation. And that could lead to a sharp drop in demand in the next year. Now, something I want to clarify with this is we don't really know. Chinese data is terrible, right? So we can't really see what's happening. But in the instance where this does occur, that could lead to a sharp drop in domestic demand in China, which leads to a sharp drop in domestic demand all around the world. And for a country like Australia or a country like New Zealand, that means a lot less demand for the products they're buying. Now, if we had to put probabilities on this, I'm going to go with Larry Summers, right? There's a 1/3 chance of this. There's a 1/3 chance that the Chinese consumer does go buck wild and start spending, and there's a 1/3 chance that neither thing happens, right? And that's because we have no real idea about the data. So this is a scenario, not a forecast.
That's beautiful.
Now, this economic shock that you brought up here, Gulnara, this looks like for a country like Australia and New Zealand, it's about what people in China are buying, which is commodities, right? It's coal from Australia, it's dairy products from New Zealand. In a historic context, Australia's terms of trade has been high for nearly 20 years. And this has come from strong Chinese demand boosting export prices. Now, the terms of trade reflects the price of things Australia sells overseas compared to the price of the things that they buy. So the fact that China's become more and more productive and has driven down the cost of buying imports has also helped out with that. And this has also helped out both countries when they've experienced weaker productivity growth. Because if you can buy more imports with the same number of exports, that's sort of like getting a productivity gain. You're getting more stuff from overseas for making the same amount of stuff here with the same inputs. Now, if this scenario about China comes to pass, it's unlikely that export prices in the terms of trade will stay high going forward.
So this isn't just the story of the last 20 years, Matt, but also part of the story of the post-COVID period, where high, hard commodity prices have assisted the Australian economy. If Chinese domestic demand drops and financial conditions in China tighten, there is a real risk this translates into a lower terms of trade and lower incomes in Australia.
Just a second here, Gulnara. Before you carry on with that point, is it really true that the terms of trade became a lot higher during COVID? So what were the increases? Was it slightly higher than its prior highs? And if I think back to 2011, 2012, that's when the terms of trade was at record highs. By the time you came to 2014, you had the mining boom pop and you had the terms of trade come down. It was still higher than it was before about 2006, but it had come off the boil, and then things recovered a bit. But once we got to 2019, the terms of trade was still below that sort of record post-GFC high. What happened during COVID?
I think it became at the record highs that the Australian economy has never seen before. Like the index prices went up to 140.
140. Oh, okay. So that's 140 in about 2011 prices. So for context, there in 2011, the index would have been at about 100.
Yeah.
So you're talking probably somewhere around 30-something% higher than its peak in 2012. That is really surprising. I didn't know that.
Well, so to carry on our debate today,
We're not debating. No way.
An important thing to focus on here is not just the general lower income, but the likelihood that this translates into a lower exchange rate. Even with the record high terms of trade, which you have just highlighted, lower interest rates in Australia have kept the currency at the lower end of its historic averages. A sharp drop in commodity prices would see the exchange rate plummet, which will threaten its lows in the early 2000s. So a lower Australian dollar means high imported good prices. So one way to think about it is that a lower dollar ensures exporters against a drop in world export prices by sharing the burden with all Australian households. These higher imported good prices will then show up all around the show, but the key things people will notice will be A, petrol prices, and B, durable good prices. So experiencing more expensive fuel and more expensive washing machines is something that sounds familiar to those who lived through the 2021-2022 period.
Oh, yeah.
Yeah. But with weaker external demand, this would also show up in higher unemployment. So how will policymakers deal with such a shock? Well, that's the subject for a post from Matt in the new year. So I'll hand it over to Matt to give a little bit of a teaser for it.
Well, I'm fairly biased in terms of the things I'd cover, but I'd probably look at two policy debates because I like keeping things even. There are two shocks. Let's think about two policy debates. What I'm feeling is that we have a situation where unemployment's rising while real incomes are still under threat. So there's going to be a big debate about protecting jobs or protecting household income. Do we insure individuals' incomes, or do we ensure that they keep the job, that they retain it? I think the policy debate in Australia has been polluted by this idea of job retention schemes, and it's going to lead to a real conflict I'm not sure economists are particularly well armed to really discuss. And it's going to be a lot of fun if this scenario occurs, which I hope it doesn't. The second policy debate I'm sort of seeing is, well, you brought up exchange rates. Maybe I'm exchange rate pilled from my time in New Zealand, but whenever there were big swings in the exchange rate, there was always push to compensate whoever was losing. If we have people suddenly finding that it's really expensive to buy a washing machine, really expensive to buy petrol, we've already had cost of living related payments in Australia. Wants to stop more of those being pushed for as well. So within this context, if households are having to pay for the fact that export prices have fallen, will policymakers just sit idly by, or should they do something to help support individuals' income? Now, that's a teaser for where I see things going, but I have to actually do some thinking before I write anything up, so don't expect that anytime soon. What I can say is make sure you have a Merry Christmas and that you argue respectfully with your relatives about economic issues, very forcefully and strongly and clearly, but respectfully. And, while you're having Christmas lunch, remember to finish your food and swallow it before you start your argument again. We'll see you all in the future. Au revoir.
Merry Christmas. Bye.